So you're thinking about building a house and you're thinking, what the heck is a construction loan? How does it work? How do I qualify? What's the process? What are the risks involved with it? Well, in this video, we're going to talk about all of that stuff. And if you stick around to the very end, we're going to give you some tips on getting the very best deal on your construction loan. My name is Tom Jung with Tom's Texas Realty Group, and we get phone calls every day from folks just like you, whether you're a few days or a few months out. So if you are looking to buy or sell here in the great state of Texas, please don't hesitate to reach out to us. And if it's your first time to the channel, please subscribe. But yeah, without further ado, let's jump into it. What is a construction loan? So construction loan is just a type of loan for constructing things. So this also applies in a lot of other cases, but in this video, we're going to be talking specifically about using that construction loan to build a house. So you can't do a traditional type of mortgage. Like you've probably heard of a conventional FHA, VA loan. Those do not apply when building a new home because the bank can't lend you on a house that does not yet exist. So they've come up with this other product called a construction loan. And with that, they basically give you money as the house builds, right? So you're borrowing that money as, you know, each step of that house completes. You get a little bit more, a little bit more, a little bit more. So there are two main types of construction loans that you're going to hear about. One is your conventional construction loan, where that's straight up just what it is. They're giving you a loan to build a house, and it is a temporary financing thing. Usually it's going to be 12 months to 18 months. And at the end of it, that's it. You are supposed to pay off that loan. So most people will refinance at the end of that. And the other type of loan is a conventional to permanent, right? So they sound very similar. The only difference is basically with the conventional to permanent, you only close one time. So basically at the end of the build, the note automatically converts into another mortgage. Now the trick about this, so a couple things to know on this. If you're doing the one-time close, typically those are going to convert into like a 5-year adjustable rate mortgage, and it's going to be like a 20-year term. Most of the time, the banks that offer these do not convert into like your traditional conventional 30-year note, right? So that's one of the drawbacks to going that route. Obviously, you're going to save on closing costs. I was talking to a lender today, and to go the regular route and then refinance at the end into a conventional loan, you're probably spending about $3,000. You've got to update your title policy. So typically you're not going to pay the full amount of a title policy again. And you're going to have to get a new appraisal, maybe a survey, and you'll have some escrow fees that go along with it. It's probably about $3,000 as far as the cost goes to converting to permanent financing at the end. So anyways, those are the two types. If you got any questions, let us know in the comments. So how to qualify for one of these loans. So it's very similar to, in some ways and in some ways not, it's very similar to qualifying for a regular home loan, right? Because the bank knows at the end of the day that you are going to need to refinance that note. And if the numbers don't make any sense and they can't do the refinance, they're not going to want to give you the loan. So very similar. They're going to want to see, they're going to take a look at your debt to income ratio. And if you're not familiar with debt to income ratio, basically they look at how much money you make. And this is like what your gross income is. Most of the time they're not going to include bonuses or, and they don't include, forgot the term. Basically, if you sell stocks, that doesn't count as income. It's different in accounting world. It's different. Golly, forgot that. Somebody put it in the comments. You can put it in the comments, whatever it's called. Capital gains. Boom. Got it. All right. So you have your gross income, and then they're going to look at your fixed debts, right? So if you own a house currently that you're still paying a mortgage on, there's a good chance that they're going to count that against you. They're also going to count your property taxes, your HOA dues. If you've got, child support or student loans or a car payment, those are all fixed things that you have to pay every month, right? So they subtract that out, and then that remaining amount that you've got, they want to make sure that that's enough money for you to buy the house or to pay it monthly, right, and still live on the amount of money you have, right? So they want to make sure that you're gonna have enough money to pay them. And So they're going to look at the debt to income ratio. They're going to look at your credit score, and they are going to look at how much money you got in the bank. So with these loans, typically, they're going to require probably 20% down. And so this is the thing. This is not like your cookie cutter product. This is going to depend greatly on what bank you go to, right? So they may require 15% down. They may require 30% down, right? And this is why in this particular case, you really want to shop these around, because, different banks have different products. And a lot of times, banks have so much money they can allocate towards certain types of loans. And when they get close to the threshold, maybe they bump up the minimum down as to discourage people from doing those type of loans until they balance out the rest of their portfolio. So, this is where having a relationship with your local bank comes in handy. And, and it's also prudent to shop around and see what kind of rates other people offer. And we'll talk more about tips and get into that a little bit more at the end of the video. So anyways, that's basically it. So you would go into the bank, you say, hey, this is what I want to do. You lay everything out, and they're going to take a look at all that kind of stuff, right? They're going to take a look at the land, what it's worth, what the house will be worth when it's done. They'll have some kind of appraisal to make sure that everything that you're doing makes sense before they lend on it. And if everything looks good, they're like, okay, cool, we'll give you the loan. So let's talk about the process from start to finish. We'll run you through an example of how a construction loan works. And let's just assume, in this example, let's just assume that we're buying a piece of land for $100,000 and we're going to build, we're going to spend $400,000 building the house, right? So in total, it's going to be $500,000. And let's say that your bank is requiring 20% down, okay? Just for easy math. And so, and let's say that you don't own this land yet, right? So if you own the land, you're just getting the loan for the house. And you can use, let's say that the land is worth $100,000, you can use that as your down payment, right? Or if, let's say that you have, let's say that the land is worth $200,000 and you've paid off $100,000 of it. Well, that $100,000 that you've paid off will count towards your down payment on this loan, the 20% down, right? So they're going to look at the whole thing and make sure that they have at least 20% equity is essentially what that's how you need to look at it, right? So when the house is done, land, house, do they have 20% equity? Where did they get it from? Or 15, 30, whatever that bank requires. So, but let's go through an example where you are going to go out, buy a piece of land, build a house on it, and we'll walk through it that way. So first thing I'm going to tell you is when you write the contract on that piece of land, you want to, number one, make sure you have an agent, make sure you're not buying something that is going to be difficult to build on or you're going to have problems with, it's in a floodplain, all that kind of stuff. It's good to have an agent that knows what they're doing. But you would want that contract to be probably 90 days out for the closing. And that's going to give you enough time to, number one, figure out who your builder is, get plans drawn up, make sure, get soil tests, make sure that, everything is going to work out properly and get that loan in place, right? You're going to have to get an appraisal, which depending on the bank could take longer. It just depends on how they run their appraisals. So with that, it may not be 90 days, maybe 60, maybe 45. And this is something where, you're going to have to figure out all the moving pieces, figure out how much it is, but 90 is a pretty safe number. So let's say that you go out, you contract a house or contract a piece of land for $100,000. And then you go to your, you find your builder, you go to your bank. The builder's going to more than likely either have plans you can pick from or send you to an architect. You get all that figured out and say, cool, here's everything. The bank will do an appraisal to figure out, yep, this is worth what we think it's worth. It's worth at least the 500. We'll loan on it. So you go through that process. And so on closing day, you're going to show up to close on your piece of land and you're going to put the 20% down or the 100,000. So you're essentially, paying for that piece of land with your down payment. And so your actual construction note will be for the 400,000 in this example. So what happens next is the builder gets started, right? They start moving dirt around. Maybe they're going to pour the foundation. They put the septic tank in, the well, whatever it is. And they get, to the first, first milestone. And they're going to say, okay, we need a check because we did this work. Go ahead and get us a check. Or they may ask for it beforehand. Anyways, let's say you get that work done. They need to get paid, right? So you go to the bank, you say, hey, we got this work done. They probably send somebody out the check, say, yep, you in fact do have a foundation. There's a septic tank. All right. And then they cut you a check for that amount. So let's say, just for easy math, it's $100,000. And they will cut you a check for $100,000, and you then will assign that check over to the builder, right? So you are the last line of defense. You want to make sure that the builder has done what they said they've done, right? So you need to have eyes on the project as you go, because you are the last line of defense. You're the one signing that check over. You want to make sure the work is done. Typically, the bank will have these milestones throughout the build process where they're gonna send somebody out to make sure that it's done. It's probably, foundation, maybe at the framing stage, dried in, and then cabinets completion. I don't know, but that's something that you want to ask about for your bank. And how long does it take to get those inspections, right? Because if a normal build takes 7 months, and then you find out that it could take a week before the inspector gets out there, and you've got to have 5 of these different inspections by the bank, that's adding another 5 weeks to your build. So you need to calculate that in. So it's one thing just to be cognizant of. So anyways, you go to the bank, you get the $100,000, you pay the builder because they've done everything properly. Now you're going to start making payments on that $100,000. So typically the loans are going to be an interest only loan for 12 to 18 months, as I mentioned before. So you're going to start making interest payments every month on just the money that they have given you. And this is called a draw. So a lot of times you hear people talk about a draw. That's what that $100,000 is. You're taking a draw on that loan. And so you get that money, pay the builder, boom, good to go. So next month, let's say that they make some more progress. Bank's cutting another $100,000 check to you. You push that over to the builder. Now you're paying interest on $200,000. And so basically what happens to, and typically it's a lot slower at the beginning. Whenever you start doing a build, it's a little bit slower, and then things start to move pretty fast. So when you get the loan, you're going to have smaller interest payments at the front, and then at the back, they're going to get a lot more expensive because you've used most of the loan. But then at the end of the deal, once the house is built, you convert to the regular financing and you move in. So that's pretty much it. That's like the basic overview of how all of this stuff works. And so let's talk about risks and challenges. So the biggest risk that you have, I guess, is picking the right builder. So, I've heard a lot of different stories being in this business where, somebody started building a house, they went out of business, or they started building and then they just disappeared for a month, right? And so, if you're the one that's paying those interest payments, right? So if your builder disappears on you, or things are going slow, or they say, hey, I can build this house in 6 months and it takes them 12, that's 6 months of interest that you're paying that you probably didn't put into your calculations, right? So one of the things to keep in mind is that builder controls a lot by how fast they move. So you may want to have something put into your contract to where if that builder falls behind, you can fire them and get somebody else in there, which is not a great idea either. It's better just get a good builder from the start, because it's going to cost you time and money to fire them and get somebody else to pick up the job and go through the permitting process and all that. So so you may want to have something in the contract that says, hey, look, you're going to start making less and less money if this takes longer and longer. So they have incentive to be on top of the project and get it done in a timely fashion. Also, I would suggest, talking to a couple builders on build times. Like if you've got a builder that's like, dude, I can get this done in 5 months and everybody else is at 7, that's a red flag, right? Why can this guy get it done in 5 when everybody else is at 7? And let's see here, other things. So this is the other thing to think about. And I've heard horror stories about this as well. Let's say that you get towards the end of the build, right? So, at first it just looks like this framed up thing. Now it's starting to look like a box. Now it's getting some character as they put on the bricks and the stone. And then it's starting to look real pretty, but they didn't put in this, or they didn't do that ceiling right, or, this was the wrong material for the flooring. And now you've got a disagreement with the builder. Well, this happens a lot of times because people don't have good contracts in place with the builder. And a good contract, that builder is going to outline everything that goes into the house, everything from, what type of insulation is going in to what type of light fixture goes in each room, to, you know, even the hardware. This is, you know, these are the knobs that are going on the cabinet. So they detail everything out so that there's no discrepancy. So you get to the end of it and you're say, hey, there's supposed to be beams in this living room, you know, these exposed cedar beams. And you're like, well, that's not in the contract. That's not on the plan. Oh, okay. Then at that point, you know, it's up to you. And then, okay, that's the other thing. A lot of times people change their mind, right? You start going through it and you change your mind. Every time you change your mind, it costs you money because the builder's got to stop. They've got to pivot. They've got to move things around. It always delays, right? So the more times you change your mind through a build process, the longer it takes, the more money it costs you. So that's the other thing. Let's see what other risks or challenges. Those are the main ones. The note is in your name, right? So it's up to you at the end of the day. There are situations where the builder will carry the note. That's a whole different ballgame. That requires a lot of trust. That's a whole different dynamic, right? If you own the land and they're carrying the note, that's a weird deal. Typically, the builder will want to have some kind of ownership in the land in case you don't pay him and he's got money sunk into the house, which is also a bad situation because then they could possibly take the property from you. So that kind of stuff you need to be careful on. But yeah, as far as like a traditional build where you're controlling the strings of the purse, it's really just about having a good builder in there and being very clear on expectations and having everything detailed in your contract. Those are going to be the biggest things. And the other thing, things are going to come up. Things always come up. Like little things that, you know, even if you got a seasoned builder that's been doing this for a long time, sometimes things come up that they didn't foresee and you got to figure them out, right? So just expect a little bit of that. But yeah, as far as tips go, since you stuck around to the end of the video, if you are looking at getting financing, you know, looking at making this happen, a couple suggestions. I would check. Typically, your big banks aren't going to be the best as far as these type of loans go, because the bigger the bank gets, the more scrutiny they have, and the more they want to be, hey, I don't want any problems at all, so we're going to make this loan product really unattractive unless you're just like the cookie cutter best type of, you know, person. You're making, you know, $250,000 W-2, just, you know, straight down the middle, you have no debt, that kind of thing. Anybody will pick that up, right? But if you are, you know, if that's not you, which is like 90% of everybody out there, then yeah, I think the best thing to do would be to start at like your local bank. If there are like local banks or regional banks, the smaller ones that especially the ones that operate if it's a small town in your town and know it better, because if you're asking to do some kind of project and the bank's not familiar with the area or whatever, they may be like, I don't know about that. That doesn't sound right to me because that's not how it works here. Then you could have some issues there. The other thing I would recommend too is if you are in an area where there's a builder that does a lot of custom homes or a lot of, you know, semi-custom homes, you may ask them for their lender. Even if you're not building with them, you may just call up and say, hey, thinking about building a house, who do you guys use for your lending? Because more than likely they've got some kind of relationship with somebody that does a lot of these type of loans. So they're probably they may even have a couple different options as far as their products go. So that is another call I would make. So I guess the biggest thing is definitely call and shop around. As far as rates go, they're going to be pretty similar. At least in my experience, they're going to be fairly similar, but you know, the terms of the note, like just a few different terms, the refinancing part, all of that can be a little bit different. So it's good to have a relationship with that bank and who you're working with, just in case things come up. Let's say that, you know, you got a 12-month note and all of a sudden things happen. It's going to take 14 to get the house done. You want to make sure that they're going to work with you to extend that. One last thing I will say, you know, another issue with the construction to permanent financing is sometimes it's difficult. You know, if you go over budget and you're like, hey, I need to borrow an extra $30,000, sometimes you're not able to do it in that construction to permanent financing the way that they've got it set up. Whereas if you were doing just a regular construction loan, you get to the end of it, they can put a second lien on there because they're going to refinance it anyways. It becomes, you have more flexibility. So that's another thing. I would just talk to the lender about it and say, hey, pros and cons, run me through this. But that should at least give you an idea of kind of the questions you want to be asking. So hopefully this was helpful. If it was, let me know. If you still have questions about your particular project or anything like that, please do hit us up in the comments. We'll help you in any way that we can. And as always, if you're looking to buy or sell, remember to keep calm, call Tom.